Yeah, so before we get started, quick introduction I think recognize a lot of names, but in case anyone hasn't had a chance to meet me or the rest of the team, my name's Jerry Bell. I'm one of the partners here at Elm. Uh, I'm joined by several members of the Elm team. Victor Gani, who will be kind of doing some ping pong with me back and forth, kind of going through a few slides that we have.
Got my ping pong paddle ready to go.
Uh, ping pong is Victor's newest obsession, so I'm sure you'll hear about it a little bit over the course of the today. We have we have a few prepared remarks and some polls and quizzes that we'll do as we go through things. And then we hope to leave as much time as possible for Q&A. So if any questions come up over the course of the materials, feel free to drop them in the Zoom Q&A. If there are things that are sort of, mechanical issues or things about how Elm works, there's a number of guys from the Elm team on the call who will be able to answer those questions. And then if there are any things that seem like they're really good questions for the whole group to hear, we'll save all of those for the end and we'll kind of do a little bit more of like a forum, which I think will be really fun and is typically the highlight of these calls, and something that we really like to do. Um, so yeah, oh, that's good. Thank you, D-Bag. So the call is recorded. We will share after this. We'll share a recording and we'll share the slides and we'll share any questions and any FAQs and things like that. So if you miss anything, if you need to leave, if you have to go walk your dog or anything like that, no problem. All of this information will be shared with you afterwards. And of course, we're always available to chat one-on-one if anything comes up that feels like it would be better for a one-on-one conversation, things like that. So, without further ado, we'll kind of get through, like I said, if we have a few prepared remarks and we'll kind of walk through that and go from there. So, let's get started. So, Victor, you can see a slide, I hope.
I just see the title slide
There we
actually.
go. There we go. Okay,
Okay.
like I said, so we're going to walk through a little bit about Elm, the kind of the impetus of Elm, how it started, how we invest, a little bit about the kind of mechanics of the different vehicles that we have, including our most recent exciting thing, which is our ETF, which launched earlier this year. And then we'll leave you guys with a bunch of resources if you want to learn more, and then obviously the Q&A, like I discussed. So let's get started.
Okay, great. Well, yeah, thanks everybody for being on here. And well, you can see our Elm team is all here. Um, so, you know, the sometimes, I like to try to give people the background to Elm, where it started, which is kind of, was some degree of trial and error on my part, as I started to, as I focused more and more as I got older on sensibly investing my family's savings and, learning lots of lessons, mostly painful, expensive lessons along the way. And, the I think that this idea that there's this idea of the dynamic index investing that we do at Elm, really kind of has there's two parts to it, I think. We believe in index investing on the one hand, and we believe in being dynamic on the other. And index investing is a passive kind of investing where you're investing in the market cap weighted index of all U.S. stocks or all non-U.S. stocks. So you're taking this view um, that you can't do better, after fees and costs and so on. You can't do better than having a passive allocation to, say, all U.S. equities or to all non-U.S. equities. But at the same time, we think that the asset allocation itself is something that is not really possible to be passive about, that you have to make your asset allocation based upon the expected return and risk of the different asset classes that you can invest in. And you know, when we're kind of jumping, like we're almost jumping ahead and kind of saying, oh, we're going to use index funds as the building blocks of our portfolio. And for a moment, I want to take a step back and say, why is that? Like, I mean, there's just uh, an infinite number of ways that virtually that you could build your portfolio. And there's, a myriad of different things that you can invest in. In fact, there's more collective, there's more mutual funds and ETFs and hedge funds and private equity funds than there are individual businesses and companies that exist in the world in public form altogether. So, there's just this huge, huge number of things to invest in. How can we narrow it down to to something that's like workable, given that, and also given that we don't have an infinite amount of time to study every single thing that we could possibly do. And, at Elm, we have this idea of really a four step or four level filter that we try to apply to thinking about what makes it into Elm portfolios. And we'll talk about that a little bit more when we talk about the baseline, but we're really using some kind of common sense, high level principles to decide that we just want to invest in these low cost index funds. And the criteria that we have are that we want to be very diversified because we don't want to take risks that could be diversified away. We don't believe that you should get compensated for idiosyncratic, company specific kinds of risks. So we want to be very diversified and try to earn the risk premium that we get for taking the undiversifiable risks that are out there. So, we want to be looking at, when it comes to risky assets, and we want to look at asset classes that really have a good story and reason why they should carry a risk premium. And then we want to be able to estimate that risk premium. So it has to be, we might say that oil, for instance, is a really big asset and it should have a risk premium, but it's really hard to come up with the expected return of oil. It doesn't really have any cash flows to speak of. It's much more of a supply demand thing that's hard to estimate. Then there's fees, where fees are just a risk-free cost that's going out the door. And, we just want to keep fees as low as possible. We know that we can't pay really high fees and expect to get, expect to get compensated. There's so much empirical evidence and common sense, is that with high fees, it's really hard to get risk-adjusted extra returns that justify that. And then finally, for taxable investors, we want to be tax efficient. So that's kind of our building blocks. And then, we're faced with the asset allocation decision. How much US equities, how much non-US equities, how much fixed income? And, and really, most people or a lot of people just say, well, I'm just going to be 70% in equities, 30% in fixed income. But, there's not a really strong logical basis for that. If you believe that the expected return of equities and fixed income are changing over time, then, and the riskiness of them is changing, then the asset allocation should change too. So that's kind of the high level look at what our investment approach comes from, or the principles that it's coming from. And whenever we talk to people about this, dynamic asset allocation using low cost index funds, keeping the cost down, diversification up, being dynamic, and I'm sure that so many of you are on this call because this approach to investing is attractive. But there are some issues with it. I mean, first of all, if you're just going to be 70-30 for the rest of your life, that's really easy. That's something that everybody can do. And this is more complicated. So a lot of people don't want to do this on their own, and they feel that if they want to hire somebody to do this, that it would be expensive. Well, what we're trying to do is deliver this investment approach, low cost, get the economies of scale and let people have access to this. We realize that it's something that's hard to do on your own. It's time consuming, it's complex. The other thing is that a dynamic asset allocation means that sometimes you're going to be selling equities. That it's not just buy, buy, buy. I mean, sometimes it's buying, sometimes it's selling. You're changing your asset allocation. And so if on average equities go up and sometimes you're selling them, you're realizing capital gains. And most people would like to defer capital gains as long as possible. The more that you can defer paying capital gains tax in general, the better off you are. Of course, if capital gains tax rates go up a lot in the future, you won't be better off. It might have been better to pay it at lower rates today, but in general, long-term deferral is good. And so what we've tried to do there is to be as tax efficient as possible as well. And in our separately managed accounts, we'll talk about our different structures later on. But in separately managed accounts, where we're doing the investment approach within everybody's individual accounts, we're doing tax loss harvesting, we're doing tax aware rebalancing, and we feel that we can get the effective tax rate pretty close, not exactly as low as, but expectationally pretty close to the effective tax rate you would have with a long-term buy and hold approach. So we can't get all the way there, but we can get pretty close to, I mean, I would say we could get within a couple of percentage points of effective tax rate difference between what we do um, and of course, it's kind of path dependent. So sometimes what we do could be better than a buy and hold. It could be throwing off some capital losses that you could use elsewhere. But in general, we can get close. But for people that are extra tax sensitive and just don't want to pay any capital gains tax for as long as possible, our ETF, which we'll also talk about, has some very nice tax features where, because of the creation redemption process of ETFs, we hope that we'll be able to realize little or no capital gains for as far as the eye can see. So anyway, so we tried to solve those different problems or those different considerations that make people are attracted to dynamic index investing, but then they're like, but what about this and that? So I thought we would just try to deal with those really upfront. Um, we love thinking about dynamic index investing or our approach as being this synthesis of the best features of passive investing, the low cost, uh, diversification, transparency, all these things that are really nice in passive index investing. But then also trying to bring in the good parts and leave out the bad parts of active eyes open investing. So using a simple set of rules to adapt portfolios to changing market conditions is what we take from the active side. And we'll talk more about basically the two rules that we have for how we vary portfolios over time. But we've been talking about dynamic index investing, or I've been talking about that the whole time. We should also say that in some ways, our real DNA is low cost, diversification, tax efficiency, transparency, and education. And what's distinctive about what we do compared to anybody else that we know is this low cost dynamic part of what we do. But we do have some clients that use us for a static asset allocation too. And we do the tax loss harvesting and monitoring the ETFs that they have in their portfolio and all of that. But we do have some clients that use us for that too. But most people wind up really being attracted to the dynamic side of what we're doing. Okay, back to you,
Okay.
Jerry.
Well, I think the next thing that we're going to get into is spending a little bit of time about how the actual underlying mechanics of dynamic index investing work. But before we do that, we have a quick two-question poll that we hope everybody will have a perspective on. So let's see if this works. Okay, can everybody see this? Okay, so we'll give everyone a second. Um, so essentially what we're asking is, according to a selection of what we think are, most people would agree are really well-known and sort of well-respected investment firms or asset managers, how do they see long-term expected returns for US and non-US markets? Essentially looking at the kind of forward-looking expectations of compounded returns in both of those places.
Right. And the reason we're asking you this question is that um, the dynamic index investing relies on an estimate of expected return for the different asset classes. And some people might say, well, how do you come up with expected returns? And we have our way of doing it, a really simple way that we'll talk about later. It's a very simple metric, but all these different investment firms, are looking at it with lots of different tools and perspectives and putting it together. And it's kind of interesting to see, is there a consensus among the investment professionals, and does their consensus strike a chord with you? I think it's going to be really interesting to see whether the 100 people or so that are on this call, how much consensus is there among all of us in terms of expected return? And we're hoping that there'll be a lot. That there's if you've taken the time to be on this call, we suspect that there's a lot of like-mindedness among us. And it'll be really interesting. We've never done this before. We're really interested to see how it comes up.
Okay, so it looks like
Thank you for
the
doing it. Yeah.
responses have started to slow. We were at about they keep coming in. We're about 80% approval. I don't think we're going to get to 100%. I'm sure we have some multitaskers on the call, but just in case.
Wow,
Yes,
80. We've got 80 answers. That's
yeah.
amazing.
Okay,
Wow,
so
that's so
in
cool.
the poll, if you're still thinking about it, get your responses in now, and then we'll end the poll and everybody can look at where we landed. Um, Oh, someone someone in the chat said if you've listened to a recent podcast with Victor, you gotten the answer to this already. So okay, so I'm going to end the poll now, and then we can share the results, and everyone can take a look at sort of where things landed. Um, is that showing up? People can see the results there.
Yep, yep, I can see it. Yeah, I can.
So what do you think? Should we go? Do you want to chat about the results, or should I go into the mechanics? Maybe we can come back to the results. I don't know. Anything jumping out to you, Victor?
Yeah, it's interesting. I think that our listener base is a little bit more bullish on U.S. equities. I think that the let's see, uh, yeah, I think if we took the expected returns across all of these, that um, actually the expected return for US, no, I think the expected return for non-US equities would still be a little bit higher. But yeah, really interesting. The a little bit more dispersion than I was thinking, and a little bit more bullishness on US equities than I was guessing. But anyway, let's take a look at what the investment professionals say about it. Right. So we see that the average for US equities nominal compound return over the next 10 years is 5%, from BlackRock to Vanguard, et cetera, and 7.5% for non-US equities. So a good 2.5%, almost 2.5% higher for non-US equities. Um, so yeah, I mean, I guess in terms of guessing the answers, that a little bit less than 50% in the first poll, in the first question, got the US right, maybe or like 30% there, I guess. And then people were more centered, like almost 50% got the non-US one at 7.5 in terms of where things were. Um,
Yeah. Well,
Interesting. That's
one
fun.
of the things not included here is we produce our own capital markets assumptions as well. So those of you who have been on the Elm research mailing list for some time, you'll notice that every quarter we publish our own versions of these as well as comments on tips yield as well. And we're mostly in line with this. I think we're probably right at the averages, maybe a little bit higher non-US, but pretty close to these, which I think is a it's we don't take that into consideration when we're coming up with our capital markets assumptions, but we do think about it, and it's always good to see where we are. Um,
Mhm.
so why do we think about expected returns? As Victor was mentioning earlier, one of the things that is important to see if you're going to take an approach where you're adjusting your asset allocation based on the market conditions, you should have a really strong kind of rules-based approach for doing so. And for us, expected returns is one of, if not the most important thing that we're thinking about, expected returns relative to a safe asset. So when we think about sort of at a high level, the way that we are approaching our asset allocation, we start with a baseline. In our ETF and our offshore fund that we have, that baseline asset allocation is 75% in equities and 25% in fixed income. SMA investors have a little bit more customization and can change that. But for the purposes of illustration, I'll just use that baseline of 75% equity and 25% fixed income. And this assumes a world where global equity markets are mostly undifferentiated from a expected return and risk standpoint. So 75% equity assumes about a 4% risk premium for global equity markets and sort of neutral momentum. Of course, very rarely does the world exist in that sort of state. And so what we are doing constantly at Elm is looking at changes in expected returns for these global equity markets as measured by our PCAPE, which Victor will talk about in a little bit. And we're looking at the risk level for these markets that we use. And we use a super simple 1 year momentum metric to determine that risk level. And as these two signals are changing, we're adjusting our asset allocation on a weekly basis. So we're evaluating whether or not, considering whether or not to make trades regularly, and then moving the portfolio to a asset allocation that sort of reflects what we think are sensible, transparent views of how the market exists today. And one of the things that we like about that is that this flexible, transparent approach provides investors what we think is a really sensible, low-cost way of holding a meaningful amount of their wealth and their family's wealth in equities over time. And this colorful chart here shows how a dynamic portfolio how we have changed exposures in response to these changes in expected return and risk. And so what you'll see is that a portfolio that sort of starts with 75% equity and 25% in fixed income in the baseline maintains a healthy equity exposure over time, around 68%, with that pretty evenly split between US and non-US equity. Which is something that our investors obviously really desire, but it gives our investors the ability to reduce exposures in cases where where equity markets are not offering much in the way of expected returns, or volatility is increasing and things are feeling a little bit risky. And so this ability to reduce exposures when things get a little hairy while also kind of keeping your baseline equity exposure high, is a really nice feature that a lot of our investors like, and people who are working with Elm, it's something that really appeals to them. So it's a really high level overview of the approach. We'll talk about it a bit more. Victor, before I go to the next slide, do you have a comment?
Nope, no, no.
Okay. Um, we talk a lot about our investing approach. We have a white paper that we've published that we'll send around after this, and to kind of get into the nuts and bolts and really dive into how these two signals work and how they kind of flow through to the asset allocation at any given point. We have tons of resources for that on our website and like I said, in our investing white paper. So I'm going to pause, and one of the things I think is always a really interesting thing to do during these conversations is to talk through the Elm model portfolio and sort of how we comprise that and kind of the things that we think about when doing so.
Okay. So, we already sort of touched on this a little, or I touched on this a little bit, earlier on, and saying, what's this kind of our our the four filters that we use for deciding what to invest in. And so there's so you can see that we're trying to represent the global equity market, and in this particular sample portfolio, that this is a client who says that they want us to run a baseline exposure for them of 75% equities and 25% in fixed income. So what does this baseline mean? What's the significance of the baseline portfolio itself? Well, for separately managed account clients, where every client gets their own customized investment program, when we're asking them for their baseline or discussing with them to set the baseline, it's a thought experiment that we use to then base their portfolio over time in other market conditions, but we need to ground it in one kind of the baseline scenario or the baseline hypothetical market conditions. And we say, okay, in these market conditions, in market conditions where all equity markets are offering 4% higher returns than you would get from government bonds, um, in such an environment and where the riskiness of equities is not particularly low, nor is it a very volatile, uncertain period of time, kind of normal volatility. How much equities do you want in that scenario, in that hypothetical world? And effectively, what we're asking them to do is to give us we're asking really for a combination of their degree of risk aversion and also how risky they think equities are in a normal environment. Um, but mostly it's really asking them about their degree of risk aversion. So clients answer that differently. We have clients that are anywhere from around 50% baseline equity exposure all the way up to 100%. And then, of course, we have some collective vehicles. In addition to the SMAs, we've got an ETF. We also have a fund for non-US investors. And in those, since it's not customized, we had to choose the baseline that we thought would be a likely baseline that would be attractive to the most number of potential investors. So for our ETF, the baseline is 75% equities, 25% fixed income. And we can't customize it. Everybody has to get the same thing in that. Uh, Now, we talked about these criteria that we have. The main four criteria are, when it comes to risky assets, are: is there a good story as to why there should be a risk premium in that asset class? Does that asset class bear risk which is undiversifiable, which is a nasty kind of risk that ought to bear a risk premium? And basically that's equity markets. Equity markets, big equity markets generally should have a risk premium associated with them because the risk of the equity market, its connection to the economic cycle, to employment, et cetera, is such that it's an undiversifiable risk that people should require extra return to bear that risk. So we like these big, broad public equity markets. From that criteria, we also like private equity, venture capital, right? Those are things, those assets should also have a risk premium, but we're going to come to why we don't have those in there in a second. Um, it's really important that we be able to estimate the expected return somehow. And that's really helpful when the asset that you're investing in has cash flows, has earnings and dividends, and it's really hard when it doesn't. It might be that gold, there's $20 trillion or something like that of gold in the world that people are holding. Maybe it should have a risk premium. There's a good reason, there's a good argument for that. But how would we estimate it? There's no cash flows. The cost of mining gold is per ounce is really low. Like, it would be really hard to model the long-term expected return of gold, and so that fails on that criterion. And then, the other two criteria are fees and taxes. Is it a tax efficient form of investment? And that's where something like high yield bonds kind of fall away for taxable investors, because their return is coming in a not very tax efficient form. And fees are just something that we're kind of allergic to. That we find it really hard to believe that markets are sufficiently inefficient that you can pay relatively high fees and get enough return to justify that. And it's really important to realize that if you pay a 1% fee on something, that somebody's out there trying to give you a higher return in lieu of that 1% fee. You're paying them the 1% fee because they're not an index fund. They're stock picking or whatever. Well, the only way that they could give you something, this higher return to cover the 1% fee, is by taking different kinds of risk, concentration risk, could be leverage risk, whatever. And uh, and so, Benjamin Franklin famously said, a penny saved is two pennies earned. Sometimes people think he said a penny saved is a penny earned because that kind of sounds more right in a way. But no, he said a penny saved is two pennies earned. And what he meant was that, a penny saved is a risk-free penny that I just saved. It's risk-free. I saved it. Two pennies that I earn are risky. I have to do some risky activity to get to earn two pennies. And so, that's one of the things that really informs aversion to fees is like not only do you need to make a higher return to justify the fee, you have to make like twice as high a return just to break even. Because if you are paying a fee of 1% and you get an extra 2% of return, but it was a risky 2%, now you're just on a risk adjusted basis, you're kind of just back to where you started. Like you need to get 3% extra return to justify that. Anyway, that's a little bit too much fixating on fees. We could we
No,
could
I
go
think it's good. I assume that most people on this call are
preaching a little
equally
bit,
averse to fee.
kind of preaching to the choir a little bit.
Yeah.
Let's go. Look, we have more participants than we started with.
Yeah.
People are
They
calling their
heard about
friends
the fee talk
saying,
and they joined.
yeah. Okay. So, um, I've been talking about separately managed accounts, customized, and our ETF, our ETF was a conversion of the very first thing we did at Elm in 2011, where we set up a private fund to invest because separately managed accounts were too expensive in 2011. And then as time went on, and ETFs became cheaper to run, et cetera, we converted our old private fund into an ETF in February. So it's been about 6 months running. It's been growing nicely. I think we have almost a 15-year track record, actually. We'll have to change that slide. From the end of 11 to from the end of 11. Oh, no, I'm sorry. Yeah, 13 years going on 14. Sorry, extrapolating a little bit. Um, so anyway, there are these two options. We could talk about the differences, more in Q&A, but that kind of lays it out there. If you want more customization, if you have assets, if you have existing assets that you want to move into the account to fund the account, and for us to manage those in conjunction with um, with fresh cash that comes in, et cetera, the SMA is the way to go. If you are happy with the standard baseline that we have for the ETF, and you're quite tax sensitive, et cetera, the ETF could be better. If you have an IRA and you want it customized or whatever, the SMA could be better for you. Really, we're happy to talk about it and to help you. We have a $2 million minimum with the SMAs. So for some people, they want to dip their toes in, they can go with the ETF as well. Lots of liquidity with the ETF, even though that on average it trades like 20, 30, 40,000 shares a day. There's like a lot of latent liquidity because the underlying assets in the ETF are all very liquid. So the market makers, can do quite a high volume of buying or selling at the bid or offer, which tends to be pretty narrow. So, okay, onward.
Let's do let's do a bit on so one of the things we've talked quite a bit about is how the SMA is more customizable than the ETF. And obviously it sort of begs the question, how is it more customizable? So if you could talk a little bit, Victor, about these three dials that SMA and that SMA investors think about before they get started, or we think about together, sort of us as an advisor, them as an investor, how we think about these dials.
Yeah. So the big one is the baseline equity risk, which we've already talked about a little bit, saying in this hypothetical world of normal equity volatility and a 4% expected excess return, how much equity risk do you want in your Elm managed portfolio? And then we'll vary above or below that if expected returns for an asset are higher or lower, or riskier or less risky. So um, now, that we usually engage in a conversation with clients about setting this dial, and lots of we're trying to find out what their risk aversion is. How comfortable are they, or how risk averse are they? How much are they kind of feel that they need a high compensation for a given amount of risk bearing versus somebody else. Also, it can really depend on what else they've got going on in their portfolio or even their human capital, what their career looks like, et cetera, what stage of life they're at. So lots of different things can come into this and come into this number. It's probably, as I say, the most important of the three dials. The next one is giving people the ability to change the US versus non-US baseline mix. Our baseline mix, the standard L mix, is kind of like market cap. It's not, we don't exactly come to it using market cap, but it's kind of as close to that. We're looking at market cap, we're looking at earnings, we're looking at relative GDP per region. And we're also building in some home bias for US investors and even for non-US investors, some home bias built into that, away from basically away from emerging markets and more towards their domestic markets. So sometimes people are like, yep, I want more US equities than what you guys have in the baseline or less. Again, it could depend on their views. It could depend on depend on what else they've got going on in their other investments. Very often we have investors that come to us and they're like, I don't own any non-US equity exposure anywhere, like everything I've got are US assets, and they dial it. They either like the fact that we're using this market cap that is more non-US equities than normal allocations have of wealth managers, or they even, dial it more towards non-US. And then the dynamic scaling dial is, how much are we increasing or decreasing the exposures, versus kind of a proportional approach. So, normally what we would do at 100% dynamic scaling, that if that if the expected excess return of an asset was 6% instead of 4%, we would say, oh, 6% is 50% more than 4%, and we would overweight that asset bucket by 50%. So if the bucket was a 20% bucket, we would say, well, based on that, we wanted to have 30% exposure or represent 30% of our portfolio. So that's what 100% dynamic scaling is. And so people can dial that down if they want their asset allocation to stay closer to the baseline over time. So when Jerry showed that slide 2 or 3 slides ago that showed how our asset allocation has varied over time, that was for 100% dynamic. And, some people might say, well, that's too much. Other people might say, I kind of like the 100% scaling, but I do want to be more tax efficient. And so maybe I'll go with 50% scaling so that you're not doing quite as much. You don't need to work quite as hard for the tax efficiency, or you can get more net tax efficiency, giving up a little bit of the scaling. So it's really, I think our clients, I mean, we have a few clients that have that set at 0 and have a static portfolio, but the majority of our clients are at 100%, but a big minority of clients also set it at like 50%. So those are the three dials. And as I say, that baseline equity one is really the one that's on an ex ante basis, the one that's going to make the most difference to your long-term risk-adjusted returns, is that baseline equity one. And you might say, just as when we were talking about expected returns earlier, you might say, geez, how do I come up with my risk aversion? How do I decide on my risk aversion? And traditional wealth managers and registered investment advisors, never really talk specifically about risk aversion. They ask questions like, do you consider yourself, more risk averse than other people? Or do you feel, I don't know, they have these very kind of subjective type of questions, and then they bucket people one way or the other, and it's not very satisfying. We feel that people can engage with the question of risk aversion much more uh, uh, um, quantitatively and much more objectively than these kind of very soft questions that we often hear around risk aversion. So, and we want to kind of,
Yeah.
explore that. So we got another poll for
Yeah,
you.
another poll. Yeah.
This is the last poll.
This is that's right. And there
Two
is
polls.
there's no homework or no takeaway. Okay, so there we go. So this one's
Right.
gonna take, I'll leave it up a little bit longer because there's a bit more reading to be done
Yeah.
here.
And the screen, you might need to just drag it to see the whole thing. There's five possible answers for both questions. And so here we're asking you to engage with the question about, what is your risk aversion? And we want to see, do people feel comfortable answering it is one thing. Do people feel, are we going to get lots of answers the way that we got lots of answers to our question about expected return? Um, and we also tend to find that people Everybody has their own degree of risk aversion, but for most people that have been thinking about investing, their risk aversion is kind of within a range. I think that I'll be surprised if we get like an equal weighting of answers here, but we'll see what we get. We're excited to see
Yeah.
how people engage with this question, and as I say, I think that a lot of times other advisors or even in personal finance books, like they never really want to address this question, head on. It's almost like a lot of investment advisors feel that their clients just can't handle this. It's like beyond them. But we don't think that. We think that people can think about this really sensibly. So anyway, we'll see in a few minutes if we're how we're doing on that. I'm going to answer them myself too. Um,
Yeah. I'll kind of talk over this, so hopefully not distracting to people who are thinking about it. It's very common for people who are getting started with Elm. Um, it's very common for us to spend a lot of time together as they're getting started to think about this risk aversion question. And um, there's a few different ways that we can engage on this big question of how much risk should I be taking with my family savings. We have a more extensive process that we've written about very recently. We call it the Elm Lifetime Investing and Spending Analysis, where we'll ask a lot of questions about personal risk aversion. We'll ask about kind of current investing and current spending, things like bequest, and we'll go back and do some fairly extensive modeling and have a longer conversation to help people understand about how we think about these questions and how we would suggest building a portfolio that reflects these preferences in a sensible way. And for people who have read The Missing Billionaires, the process feels really familiar. But it is we think, a really interesting way to approach this big question of how do I come up with an investing and spending policy that is proportional and sort of makes sense. Oh, Victor, here maybe is a good question to this last question about why are the SMA and ETF fees different? Do you want to answer that one really quick by
Sure. Yeah, yeah, absolutely. So for SMAs, we charged 12 basis points, and but you'll see a headline rate of 24 basis points for our ETF. So there's a couple of things to bear in mind with the ETF. The first one is that 24 basis points includes 5 or 6 basis points of the average expense ratio of everything that it holds in the account, all of the ETFs it holds. Whereas the 12 basis points in our SMAs is just the fee that we're charging, and you still have the 5 or 6 there. So let's just to compare it to the SMA, that the 24 basis points of fee in the ETF should really be thought of as 18 basis points of fee relative to to make it comparable and like for like to the 12 basis points in our SMAs. And the 18 is higher. The cost of running the ETF is considerable. That's why we have to charge a higher fee. But actually, on an after-tax basis, the 18 basis points for taxable investors, for most taxable investors, the 18 basis points, while it's 6 higher than the 12 basis points in our SMA, the 18 basis points in the ETF gets deducted against income. And so you could really think of that as a pre-tax cost, where the after-tax cost, depending on your tax rate, if you have a tax rate of 1/3, if you have a tax rate of 33%, then the 18 becomes a 12 basis point after-tax fee. And with the SMA, unfortunately, for most investors, they can't deduct that against income. So the 12 basis points is a 12 basis point after tax fee. So the fees are pretty comparable if you're a taxable investor in both cases. If you're a non-taxable investor, indeed, the ETF fee is 6 basis points higher. We hope as our ETF gets bigger that we're going to bring the fee down. That's our intention. And it's growing nicely so far, but we don't know what the future holds.
Okay, so I'm going to end the poll now, and then I'll share the results. Okay, there we go.
Yeah, so very few people, kind of go with the most with the lowest degree of risk aversion, that's the answer A. Um, and indeed, yeah, almost two-thirds of the answer are coming back between answer B and answer C. And by the way, these answers correspond to a coefficient of risk aversion. If you're Missing Billionaire's book reader or whatever, correspond to a coefficient of risk aversion. The answer B corresponds to a coefficient of 2. Answer C is 3, and then higher than that for answer D. So yeah,
Slightly more
pretty
risk
interesting.
seeking.
Yeah, people, I think people did, as expected, congregate around answers B and C as we would have expected. That's where the bulk of the probability mass is. But um, but some people on the call are pretty risk averse too. We have
Mhm.
22% of the people said they wouldn't risk losing 20% of wealth for any of those upsides, which is pretty risk averse. And then that's kind of a similar answer E in the second question, where if you could increase your wealth by 5x, um, would um, would you be willing to take a 20% loss, which kind of is consistent, right, with the first answer. Like the first answer is saying, um, would what would you accept versus the 20% loss? And 22% of the people said there's no gain. None of those potential gains would be enough for me to do that. And even a 5x gain wouldn't be enough for people to do that, in the second question. So the 22% is probably the same people saying they just don't, they just don't want to take a 20% loss, which is really interesting. So anyway, it feels like we got a lot of answers, which shows that people are comfortable engaging with this, which is great.
So, okay, so let's see if we can do the next two slides pretty quick so we can save some time for Q&A. What do
Yes.
you think, Ben? So fly through this one and then I'll talk a little bit about it and we'll come back.
Yeah, so I think that I just want to make one point. We won't go through this in detail. Just really one point here, which is that we feel that our investment approach is really good in trying to protect downside in typical prolonged bear markets. It's not going to necessarily do a lot of good in a very sharp V-shaped decline and recovery, like we had around Liberation Day this year. Around Liberation Day, markets got really volatile. We reduced exposure, and then the administration was like, "We were just kidding. Everything's okay." And the market came back really fast. Like that's not the kind of environment that what we do is going to really bear fruit. But in 2008, nine, in 2000, 2001, 2002, those were the more typical bear market environments where what we do helps. Choppy markets, not so good for what we're doing. But that's kind of the cost that you pay in some ways to get that protection, in those, more nasty kind of bear market situations. So, anyway, a lot more to say on that, but yeah, we have been running longer than we want, and we don't want to try your patience too much.
Okay. So the last thing before we get into the Q&A, just a little bit about Elm and our sort of investor community. So Elm investors participate in all investor calls twice a year, which are a little bit more sort of open forum Q&A where we talk about some research topics that we've been asking, and I think a lot of our investors like to hear what is on the mind of other people in our group, and that's a really fun thing that we do twice a year. We also, for some people who may have been on our list for a while, we do publish a lot of research. At least we try to. One of the things that we have recently published is sort of a new thing for us, which is a long interview that Victor and James did with Professor Robert Oman, who is famous for the agreement principle, which I think a lot of people, or I should say, his agreement theorem, which is a fun video that I would highly recommend from on the Elm Wealth YouTube channel if people haven't checked that out. Um, and then lastly, we also do a lot of events. We most recently did a sort of event at the New York Stock Exchange around the launch of our ETF. And our next event, which we are going to be talking more about soon, is a what we're calling sort of tentatively calling Personal Finance 101, which is really investment and financial decision making, but with sort of an Elm spin on it that we will be hosting in New York this November. Without further ado, let's get to the Q&A. I don't want to spend too much time on the let's get to the fun stuff. Um, okay, so Victor, this is a question that I think some people asked in the Q&A, but I've also heard this question a lot from people on calls over the last couple days. There's been a lot of headlines around CAPE at 40 or CAPE above 40, or I mean, you can pick up any piece of financial media and find some, call it top signal or something like that. How do you think about investing in a bubble in general, and how do you think about Elm's investing framework in the case of all of these things that are, a lot of what people would call top signals or froth or all of the things that people are really liking to talk about right now?
Yeah. Well, we think that it's really important to have a framework that takes that into account. So that, the PE of 40 that we have right now, or the CAPE of 40, is basically an earnings yield of 2.5%. I think maybe CAPE is a little bit lower than that, but whatever, it's in that ballpark. And that really is saying that if companies can grow their earnings with inflation if they paid out all earnings as dividends, then then that earnings yield would be a good estimate of the long-term real return of the equity market. Historically, over a long period of time, companies in the U.S., where we have that data going back more than 125 years, that companies have not even been able to quite achieve that. So if companies had paid out all of their earnings as dividends, they actually would have grown earnings a little bit less than inflation. So on a going forward basis, that feels to us like a reasonable assumption. It could be wrong. It could be that we're entering a totally different world where corporate earnings are going to like gap up to some other sustainable level because of current productivity enhancements, et cetera. We don't really believe that. And even if they could, it would have to be a lot to generate a really high long-term return. So we do agree that the U.S. equity market risk premium is quite on the low side right now. But we don't want to be zero in equities because we also want to take account of the fact that uh, that U.S. equities and global equities, for that matter, are kind of trading in a pretty low risk um, manner right now. In other words, volatility is low, is what I'm trying to say. We use our own metric for what kind of risk environment we're in, and our metric, which is 1 year trailing momentum, is positive, which we ascribe. We ascribe a low risk environment to that signal setting, and also looking at VIX, looking at realized vol, whatever. We're in a low risk environment, so we want to take account of both expected return and risk. So when we put those two together, we're today the weight on expected return is higher than the negative weight coming from expected return is a stronger signal right now than the low risk signal. So we're underweight U.S. equities, but we're about a third underweight versus baseline instead of being at zero. Now, if we go into a high risk environment again in US equities, which we will at some point, and valuations or long term expected returns and CAPE, et cetera, is around where we are now, we're going to, our US equity allocation is going to go pretty close to zero, maybe not quite all the way there, but it's going to go down a lot because this expected return is just so incredibly low right now relative to tips. So that's how we're navigating it, or that's how we're approaching it. U.S. Non-U.S. equities look different. Expected returns are higher, um, and I think that we feel comfortable with this approach to sizing the allocations. We're pleased that we're just a third underweight and not more underweight than that as the market's been drifting up. But we stand ready to reduce allocations quickly and dramatically when conditions change. And this approach worked quite well in 1999, 2000, 2001. It worked quite well in '07, '08, '09. Will it work the next time? We don't know. Will it, we think that it makes sense. We think that it's based on sound principles. And so that's how we're dealing with that. And as I say, non-US equities is definitely a better picture in terms of long-term returns. And you know this this US investors on average, are like 90% invested in US equities versus non-US, including institutional investors. Individual investors are very highly concentrated in US equities with very little foreign exposure. And given the size of the US equity market, that's really crowded out everybody and just creates this almost scarcity of US equities that we have right now. So, we have some understanding of what's been pushing the market, having the market go up and up and up. But those things can reverse also. And so we stand ready. We're not locked into a smallish underweight of US equities forever. It could be a very large underweight in the future.
Okay. I'll give you a chance to catch your breath, but I do think a good follow-up question to that is around market timing. So I'll come back to you on that one really quickly. Um, so we did get a question, and I guess this makes sense given what we saw on the risk aversion, but a question around how we think about risk aversion for younger people or people with a lot of human capital remaining. And I'll just say a few words on that. It's worth noting that for most younger Elm investors or people who have a lot of earned income left in their life, a lot of human capital, it's very common for people to be taking or to have a much higher equity baseline, something in the range of 85 to 100% or whatever sort of makes sense for them. And that's typically an extensive part of our onboarding for SMAs is thinking through these types of questions, understanding a bit about how people with a lot of human capital, like the relationship between that human capital to equity markets and sort of the correlations there, and working together to come up with what we would think is a sensible equity baseline. So that is a big part of our conversation, but we do see a lot of people with more human capital, more earned income taking more equity risk in their baseline.
Okay. So, yeah, I mean, I would love to talk a little bit about the distinction between market timing and what we're doing at Elm. And Jerry, if it's easy, if you could find our FAQ on that. So
Mm.
we have a FAQ. It's a question we get a lot. Isn't dynamic index investing market timing? And I think that there's this answer that we have on our website in our frequently asked questions, but I'd like to try to answer it a little bit differently and see how people feel about this. So this is how I would let me set up a simpler example than the market itself to try to illustrate the difference between market timing and what we're doing. So imagine that instead of investing in the market, that we're betting on a biased coin. So for whatever reason, somebody comes along and offers us the opportunity to bet our wealth on the outcome of a biased coin. And they start off and they say, okay, this coin has a 60% chance of landing on heads and it has a 40% chance of landing on tails. And you, the investor, you think about that and you decide, okay, and they say, you can bet on this for a while, like we're going to give you a number of bets that you can do one after the other, etc. And you decide uh, that you're going to bet 20% of your wealth on every, or let's say you decide you're going to bet 10% of your wealth on every flip of this coin. So it's a 60-40 coin, and you're going to bet 10% of your wealth on it for each flip. Okay. So so what I'm going to describe first is what we do. Okay. So then the person says, okay, you know what? Now the coin, I'm going to give you this coin, and I'm changing things. Now there's a 55% chance of landing on heads and a 45% chance of landing on tails. And then you say, okay, I'm going to change my bet size from 10% to 5%. And then you go along like that. Okay. So that's what we do. That's That's kind of the idea of dynamic index investing or dynamic asset allocation based on expected return and risk. So that's what we're doing. Now, what I would say market timing would be more like is that they come to the person and they say, here's this coin, it's got 60-40 chance of landing on heads. And the market timing guy says, okay, on the first flip, I'm going to bet 15% of my wealth. The next time I think it's going to be tails, I'm going to bet on tails for the next one. The next time I'm going to bet 3% of my wealth because I don't think it's that likely. I think the next coin is not that likely to come up heads. And they're doing this. And then the shift down to the 55, 45 coin and the market timer continues to kind of make what look to us like relatively arbitrary decisions on what the next coin flip is going to look like. Well, if you do that other thing, if you do this kind of arbitrary thing, that's what we would call market timing. And that's not going to end very well. That's not going to produce any kind of sensible risk-adjusted returns. Whereas we think that what we're doing makes sense. Now, having said that, right, let's say that there's 100 flips that when they change the coin to being a 55-45 coin, they give me another 100 flips on that coin. And it turns out that 55 times it came up heads and 45 times it came up tails, right? And I was betting 5% of my money on that coin all of those times. Well, somebody might say, gosh, Vic, you would have been so much better off if you just kept betting 10% because 55 times it came up heads. And we could figure out that if I were betting 10% of my wealth and the 55 times it came up heads, I would be better off than betting 5%. And like that's the criticism of what we do is like, well, look, the U.S. equity market has gone up so much, you should have had more in the U.S. equity market. It's like, well, no, we want to have the right amount based on the expected return and risk. We want to have what's the right amount. And yes, if it turns out that the equity market goes up a lot, we're going to always say we didn't have enough. And if it goes down, we're always going to say we have too much. But there's a right amount on an ex ante basis. And making those decisions on this ex ante basis is kind of feels really comforting, logical, sensible. Market timing is much more this thing of I'm reading the paper, tariffs are coming, I'm going to go short equities or I'm going to sell all my equities. Look at OpenAI just launched ChatGPT 5. It's really great. I'm going to increase my equity exposure, whatever. Like that, we don't think makes a lot of sense. But basing things on long-term expected return and risk and your degree of risk aversion, if it's an SMA or the aggregated one in our ETF or whatever, we think that makes sense. And that we wouldn't call it market timing in the way that people think about what market timing is. And I think the way we answer it in the FAQ is a lot more condensed than that. But anyway, I thought I would go for the
But
full.
yeah, I appreciate the full credit. Um, well, we're over time per usual. Any final questions? Um,
There's so many great
I
questions
know
here,
it really
but
is.
I'm really sad that we can't get to all of them. But we'll get to all of them. Uh, I think we'll get to all of that. We'll write to everybody or answer them all somehow. Yeah.
Oh yeah, so we'll have the questions, and unfortunately, some of these are anonymous, so I don't have a way to get in touch with these people. But
Or I
anything.
guess we could. Yeah. Anyway.
So there's been a few questions about CAPE or expected return metrics or PCAPE. The best place to get the full response, to really dive into PCAPE is the PCAPE blog post on elmwealth.com, which is here, and it's under the research section, and it's just elmwealth.com/slash PCAPE. Um, the other thing is that we will be publishing our updated capital markets assumptions in about 10 days, which we update on a quarterly basis. And we typically write a little bit about sort of what we're seeing. I'm almost certain that we will. I know this because we've been talking about it already, but we'll probably write a little bit about CAPE at 40 and how we think about that, and just because we've gotten so many questions about it. So stay tuned for more, for us to expound a little bit further on all of that. Um, a few.
Do you think there's like a few questions we could answer like with one, like, should we try to think about any of these questions we could answer with one sentence just to try to help
Yeah.
people?
Yes. Yeah. Yeah. We can take turns. I'll do one
Okay.
first. So the
Okay.
ETF does pay a dividend. It'll pay a once annual dividend. Um, we think it's, the current SEC yield is like 2.8, I believe. We think it's going to be somewhere around 2.5 to 3%, paid once annually in the middle of December. And that is, we can't say specifically what the yield is because our asset allocation is moving all the time, but it's some combination of the dividend yield of our equity holdings and obviously the actual yield of the fixed income holdings. But we expect it to be, like I said, once annually around 2.5 to 3%.
Okay. Somebody asked, when were markets not dynamic? Markets have always been dynamic. I think we didn't mean that by the title, that there was a time when they weren't dynamic.
Yeah. But I think it's a fair question. If
Yeah.
if markets have always been dynamic, then you should always have a dynamic approach to what your asset allocation looks like.
Yep.
Appreciate the tee up there.
Uh, New vehicles on the horizon. I think that I mean, I think there was two questions on this. Uh, I think that if we were going to do another ETF, it would be an ETF that had 100% equity baseline. But I think that we're pretty far away. Like, I think we're, a couple of years away from that. I think we need our existing ETF to get really big, to get more recognition, to get on more platforms, and then that would come. But yeah. Uh, the Somebody's asking about the current equity allocation and also the allocation in the ETF. On the ETF website, elmfunds.com, you can see the exact allocation of the ETF. And also we have this allocation tool that you can use for different parameter settings for SMAs, or if you set, I think if you set it at non-taxable and 100% dynamic, 75% baseline, that gives you the ETF. That gives you the ETF asset allocation too.
Yeah, sh should be said. We try to be as transparent as possible. Everything that we've discussed today can be found on the website, and our asset allocation table is updated daily. I guess in theory you could run your own dynamic asset allocation portfolio you just using our tools, and we think there are some people who are doing that, but um, it, you can find
Yeah.
all of these things on our website.
Yeah. Yeah. And there is historic data performance on the ETF before becoming an
Oh,
ETF.
that's right.
Somebody's asking where you can get a blue jumper. I don't know if that's your blue jumper, Jerry, or
I think
mine.
it's both of our. Well, I also noticed that in one of the pictures I'm also wearing. Look, I only have one sweater, and it's the navy blue one, so it's. So, um,
Yeah, well, sorry, and if you've asked a question and somehow we haven't answered it, just shoot us an email. We'll take care of it. We'll answer your question there, as well. So if we've missed any, sorry, there's a lot of good ones. Some of them have much longer answers, but all good questions. And please email us if we haven't answered it somehow.
Yeah, I mean, I guess that we'll finish with this one. So someone said they're surprised that our EM and TIPS weights their EM weight is high. I mean, I think it's a really helpful way to think about, a really helpful way to understand our asset allocation. Um, Emerging markets have a really healthy risk premia and currently have very positive momentum. And both of those signals are sort of pointing in the same direction, which typically, in our framework means that we will have, a healthy overweight to that asset class.
Well, thank you, everybody. Thanks for being extra patient with us as a little bit longer than normal with the polling, but that was really fun.
Yeah.
Great.
Okay. Thank you all.